Let's unpack this. Today, we're taking a deep dive into the latest financial snapshot of Gabriel India Limited. We've really dug into the nitty-gritty here, got the board meeting outcomes, the unaudited financials for Q1 FY26, both standalone and consolidated, and their big investor presentation, too.
Right. And our mission for you today is really to cut through all the numbers, the corporate jargon. We want to pull out the most important insights, not just how Gabriel performed, but why it actually matters and what strategic moves they're making. Big stuff happened there. This isn't just reading out results, it's understanding the shifts in a really key player in the auto and industrial scene.
Okay, so how did Gabriel India kick off their new financial year? Q1 FY26 results, what's the headline? What are the top-line figures telling us?
Well, what's really impressive, I think, is the consistent growth. It's quite robust. For the quarter ending June 30th, 2025, their standalone revenue from operations hit ours, $9,846 million. That's a solid 13.9% jump year over year compared to Q1 last year. Pretty strong.
13.9%, okay.
Yeah.
And consolidated.
Even stronger, actually. Consolidated revenue reached ours $10,984 million. That's up a full 16.0% from the same quarter last year. So, yeah, clear market demand, strong momentum right out of the gate for the fiscal year.
And that impressive top-line growth, is it translating, into the actual money they're keeping, the bottom line?
It is, absolutely. Their standalone profit before tax, PBT, that grew a healthy 6.6% year over year, comes out to ours, $737 million.
Yeah.
And critically, their net profit after tax, the PBT, that increased even more by 10.5% to ours, $557.7 million.
Okay, so better growth on the net profit side.
Exactly. Consolidated figures show similar healthy progress, PBT at $814 million,
Yeah.
PAT at $620 million. It really demonstrates they're not just growing revenue, they're doing it efficiently, converting sales into real profit even while expanding.
Right. And speaking of expansion, you mentioned investments. How does their cash flow look, especially with the capital expenditure this quarter?
Good question. Their cash flow from operations was quite strong, actually. Ours, $502 million. That's a decent increase from $348 million the previous quarter. So generating cash, but they also made substantial capital expenditures, CapEx. About ours, $746 million invested. And a major chunk of that, as you hinted, went into their new Chacon 2 plant. That's a strategic capacity boost.
Okay, big investment there. Did it impact their cash position much?
You'd think so, but despite that heavy investment, their net cash position remained robust. Over 3,000 million rupees ours, 3,057 million to be exact. Now, there's an interesting detail here. Working capital days stood at 29 days.
29 days. What does that signify? Is that high?
It's a bit higher than usual for them, yeah. It basically measures how quickly they turn investments into cash. But the documents note it's directly tied to higher inventory levels at that newly acquired Chacon 2 plant. So it's expected to normalize probably within the next quarter.
Okay. So it's a temporary thing tied to the new facility startup.
Precisely. So for you, the learner, this really shows targeted strategic investment for future capacity. It's not just, operational cash burn.
Got it. So the takeaway here is growth, profitability, and strategic investment without really hurting their cash balance. Seems like a strong start. Okay. With those strong financials as a foundation, let's peel back the layers. Where is this growth actually coming from, segment by segment? What's the revenue mix look like?
All right, looking at Q1 FY26, the segment mix, it shows a continued heavy reliance on 2W3W vehicles, 2- and 3-wheelers. That's 62% of their revenue.
62%, still the core?
Still the core, yeah. Followed by passenger vehicles, PCs, at 24%. Then commercial vehicles, CVs, at 11%. And a small bit from trading at 1%. And channel-wise, OEM customers, the vehicle manufacturers themselves, they dominate. 87% of sales.
87%, wow.
Yeah. While aftermarket sales, replacement parts, services contribute the remaining 13%.
Okay. Now, what's really fascinating is digging into the domestic market performance within these segments. Any key wins you can highlight?
Definitely. In that big 2W3W segment, they saw solid 12.4% year-over-year sales growth, driven significantly by major players like TVS and HMSI. Gabriel holds an impressive 32% market share there.
32%, that's significant.
It is. And they're not just sticking with incumbents. They added new programs like with Ultraviolet Concept X and OLED Gen 3. So keeping an eye on the EV space too.
Interesting. What about passenger cars?
Passenger vehicles, sales jumped 11.1% year over year, largely thanks to strong demand in utility vehicles, SUVs basically. Gabriel commands a 25% overall market share in PVs, but even higher, 27% specifically in UV sales.
Strong position in SUVs. And commercial vehicles,
That's
CVs.
where they really shone this quarter. An outstanding 29.1% year-over-year sales growth, almost 30%. And they hold a near monopoly market share there, 88%.
88%. Incredible dominance.
Absolutely. Bolstered by new programs with giants like TML Tata Motors for their Coral and Intra V70 models and VECV's 2.5, 3.9T models.
Okay, so across the board in OEMs, very strong. What about the aftermarket segment, that 13%?
The aftermarket delivered a healthy 12% year-over-year sales growth in Q1. Steady growth there. And they've been quite active. Launched a new three-wheeler trailing arm product line, introduced 97 new SKUs, new product variations just in this quarter.
97 new parts. Busy quarter.
Very busy. Their focus remains on expanding into smaller B and C class towns domestically and also strategically targeting growth in export markets like Latin America, Australia, and Africa for the aftermarket.
Right. So for you, the learner, this paints a clear picture. Gabriel isn't just maintaining leadership, it's strengthening it. Across diverse segments, they're aggressively expanding products, widening distribution, deepening roots, while also, reaching for new opportunities. Now, here's where we shift gears a bit and maybe look towards the future. Beyond their traditional auto components business, how is Gabriel innovating, expanding into new areas? This feels like more than just organic growth. It feels like a strategic pivot.
It absolutely is. You can see they're proactively pursuing several strategic growth drivers. Take exports, for instance. While it's currently only 3% of total revenue, about ours, 301 million, the composition is diverse. America and Asia each account for roughly a third.
Okay, small but diversified export base.
Right, and they're making a concerted effort now to expand into international OEM and aftermarket customers. And here's a key point. Manufacturing of solar dampers for export is expected to begin in Q1 FY27.
Solar dampers. Okay, that definitely caught my eye in the report. Sounds like a significant diversification. What exactly are those, and what's the opportunity?
It's a huge strategic move, potentially. Solar dampers are basically components that help stabilize solar trackers. Those are the mechanisms that let solar panels follow the sun across the sky. Dampers maximize energy capture, prevent damage from wind, vibrations, that sort of thing.
Ah, okay. So leveraging their core suspension tech for renewables. Smart. Is the market big?
It's significant and growing fast. The global solar damper market is estimated at USD 326 million in 2025 and projected to grow at nearly 15% CAGR through 2030. That's a hot market. Gabriel has already secured orders, 2 export customers, 1 domestic. Domestic production starts FY26.
Wow. So they're moving quickly on that. It's not just an idea.
Not just an idea, it's a direct entry into the booming renewable energy sector, leveraging their core tech. Very strategic.
And they're also venturing into e-bikes. That seems like another forward-looking play.
Yes, another key part of their future mobility push, e-bikes. They have 2 fork models, that's the front suspension for bikes, ready for customer demos and testing. Discussions are apparently ongoing with potential customers.
Fork models ready. Any IP.
They've even filed a patent for a new fork design. And they're developing a specific cargo bike fork that got highlighted in a major industry magazine, SAZ Bikes, just last June. So gaining visibility there too shows they're serious.
Okay, so solar e-bikes, very future-focused, but they also have this long-standing presence in railways, right? How does that fit in? It seems quite different.
It is different, but it shows their adaptability and deep engineering roots. Gabriel's been supplying the railway sector since, believe it or not, 1978.
78, wow, long history there.
A very long history. And they've evolved, moved from, conventional coach shock absorbers to modern applications, things like dampers for the high-speed Van de Vaart coaches and for Siemens e-locomotives. So it reflects adaptability, a long-term commitment to diverse, heavy transport segments. Provides a stable, high-value revenue stream alongside these newer ventures.
Right. So what this all means for you, the learner, is Gabriel isn't sitting still. Not at all. They're proactively diversifying, investing in high-growth next-gen tech like e-bikes and solar, while cleverly leveraging their established expertise in traditional heavy industries like railways, building a multifaceted future. Now, the financial documents also hinted at some really significant corporate restructuring, new partnerships too. Let's unpack these big strategic moves. They seem to be reshaping the company's foundation.
Absolutely. One pivotal move was the asset purchase agreement with Morelli Motherson Auto Suspension Parts Private Limited, MNAS. That acquisition completed April 1st, 2025. It significantly boosted Gabriel's capacity, an extra 3.2 million shock absorbers, 1 million gas springs annually.
Big capacity jump really cements their market position in suspension then.
Exactly, cements their leadership. And it was complemented by a license and technical assistance agreement with Marelli Suspension System Italy. So bringing in global tech too.
Okay, acquisition strengthening the core. They also announced a brand new joint venture. Sounds like a step into a completely new product line.
Precisely. A JV with Janeapco Ltd. They're a South Korean global leader in automotive and industrial fastener technology. Think nuts, bolts, specialized
It's
fasteners.
fasteners. Okay,
Yeah.
that is a new area for Gabriel.
Total new. Gabriel's investing Ors $268 million for a 51% stake in the JV entity, Jinhap Automotive India Private Limited. It'll be a subsidiary. The strategy is clear. Enter the fasteners business, meet localization needs for their big anchor customers, and tap into the broader Indian fasteners market. That deal is expected to wrap up by end of October 2025. Adds a whole new dimension.
Okay, fasteners JV. Then there's an interesting update on an existing JV, in Alpha Gabriel Sunroof Systems IGSSPL. Something significant happened there that definitely caught my eye.
It did. And it really highlights the complexities, of operating in a regulated environment. So the background. JV formed May 2023 with Inalfa Roof Systems from the Netherlands, world's #2 in sunroofs. Plant in Chennai, aiming for 200,000 sunroofs a year for Hyundai and Kia mainly. Plans for a second line were even in the works.
Sounded promising. Big anchor customers.
Very promising.
Yeah.
And this is but the Ministry of Heavy Industries, Government of India, rejected the application for the necessary approvals for the JV agreement. That rejection came through August 14th, 2024.
Rejected. Wow. That's a major hurdle. What happens now?
Well, Gabriel India stated they are currently evaluating the situation, which means they're figuring out the next steps. It's a considerable setback for that specific venture, no doubt, even though the domestic sunroof market itself is still expected to grow nicely, around 16% CGR predicted.
Right. That rejection is a significant bump in the road, especially when other big moves like this composite scheme of arrangement seem to be full steam ahead. That scheme sounds like a massive overhaul of their whole corporate structure.
It really is.
Yeah.
If we connect the dots, this composite scheme is truly transformative. It's not just shuffling papers. The strategic rationale is multifold. It's designed to redefine Gabriel, moving them from being primarily a suspension company to a diversified, tech-driven mobility solutions provider. That's the key phrase. It reduces their product concentration risk, less reliance just on suspension.
Okay, becoming a broader mobility solutions provider. Makes sense.
Right. It also enables direct collaboration with foreign strategic partners, potentially simplifying things, and facilitates synergies through economies of scale by bringing things together.
So what does this ambitious scheme mean for you as a shareholder or just someone watching the company?
Well, it consolidates various auto component businesses under the main Gabriel umbrella. Gabriel becomes the engine for growth. Crucially, it directly addresses those long-standing investor questions about diversification and M&A strategy. It does this by bringing existing, mature joint ventures under Gabriel's direct control.
Folding them in.
Exactly. And the company anticipates increased scale without taking on new debt or spending cash for these integrations. That's key. They project an impressive earnings per share EPS accretion, about INR 7 per share boost. That's roughly 41% higher EPS projected for FY25 just from this restructuring.
41% EPS boost, that's huge.
It is. Should lead to better cash flows, potentially significant wealth creation for shareholders. It also makes them more flexible, enhances their ability to raise funds for future growth, both organic and inorganic. Technically, it involves demergers, transfers of businesses into Gabriel, other internal mergers, and issuing shares to existing shareholders. But the end result, a simpler, more consolidated group structure poised for growth.
It's a very bold, ambitious plan then. Simplify, consolidate, and really set the stage for aggressive future growth and diversification.
Okay, beyond the financials and these huge corporate moves, how is Gabriel India strengthening its sort of operational foundations, its long-term vision? Are they just chasing growth, or are they building for resilience too? Oh, they're absolutely building for resilience. You see a really profound emphasis on research and development, R&D. They have the Gabriel Europe Engineering Center, GEEC. That's a hub for advanced damper design, vehicle dynamics. Their Pune Tech Center is an IGBC-certified green building. And across their Hoser and Chakan Tech Centers, both recognized by the government's Department of Scientific and Industrial Research, they have 72 R&D specialists.
72 specialists. That's a solid team.
It is. And they're productive. 87 patents filed to date, 32 already granted. That shows a robust innovation pipeline. This isn't just about, having good ideas. It's about owning the intellectual property. That's what differentiates them, secures their future in these new competitive markets.
Right, owning the IP is key. What about operational efficiency? Day-to-day stuff on the ground.
They have an initiative called Core 90. It's a focused cost reduction drive. Targets manufacturing optimization, getting working capital tighter, managing fixed costs, and the emphasis is on speed and urgency. So not just cutting corners, but really streamlining operations, making them more agile, more profitable. That feeds directly into stronger financials, better competitive pricing power.
Core 90. Okay, and their commitment to sustainability, that seems to be a growing focus everywhere.
It is, and their mission is highly ambitious. They aim to be carbon and water neutral by 2027, with zero waste going to landfill.
2027, that's soon. Are they making progress?
They're making tangible progress, yeah. In FY25, 5 out of their 7 plants achieved zero waste to landfill status. That's pretty good. They are 45% water neutral now, up significantly from 25% just the year before. And 17% of their energy needs are met from renewable sources, up from about 15.6% in FY24.
Okay, real numbers moving in the right direction.
Exactly. And these aren't just, feel-good numbers. Achieving water and carbon neutrality impacts their operational costs. It future-proofs them against rising environmental regulations, resource scarcity, and enhances their appeal to ESG-focused investors. Plus, they're getting external recognition. Awards for quality from Ather Energy for environmental initiatives from Suzuki Motorcycles just in Q1.
Good validation. They also seem to have significant corporate social responsibility initiatives, CSR.
Yes, deeply embedded, it seems. Through the S&S Foundation, they support critical areas. Education benefiting over 8,000 students. Health and hygiene, there's a proposed water ATM project mentioned. Community and environment projects, renewable energy, rainwater harvesting, and vital skill development programs.
Skill development, what kind of impact there?
Well, they mentioned 146 youth graduated from NSDC-approved courses. And for those who found jobs or started businesses afterwards, it saw a remarkable 49% increase in family income. So that commitment to social good, it directly contributes to a stable workforce, strong community ties, which ultimately fosters long-term business sustainability.
Right. So for you, the learner, this really paints a picture of a company that's not just laser focused on quarterly numbers. They seem deeply invested in innovation, operational efficiency, and a robust commitment to environmental and social responsibility. These foundations, they're crucial for long-term resilience, value creation. It's a holistic approach to growth.
So to summarize everything we've unpacked today, Gabriel India Limited, they've delivered a remarkably strong Q1 FY26, impressive top-line growth, solid financial health, that's clear. But simultaneously, they're undertaking these really ambitious strategic transformations, diversifying into exciting new segments, e-bikes, solar dampers, and streamlining their corporate structure to become this more integrated, comprehensive mobility solutions provider.
Yeah, the real takeaway here seems to be that Gabriel India is making very bold, calculated moves, diversifying, solidifying its market position far beyond just suspension parts. They're aiming for these comprehensive mobility solutions that could really redefine their future trajectory. It's quite a transformation story unfolding.
It absolutely is. And this transformation, while ambitious, isn't without its challenges, as we saw. Considering that unexpected regulatory rejection of their sunroof joint venture, even while other big M&A moves proceed smoothly, it really raises a key question, not just for Gabriel, but for the broader Indian auto ancillary market. How might companies navigate future partnerships when the regulatory landscape can present these unexpected hurdles? And, what could this imply for the pace, maybe the nature of diversification strategies in this whole sector moving forward? Something to watch.